The first speaker in this session is Michael Blakeney, who's the Investment Director, Blue Sky Water Partners. Michael has responsibility across Blue Sky's real asset portfolios, including water and agriculture. He focuses on portfolio management as well as investment identification, execution and management. He has over 15 years direct agricultural management and investment experience in Australia and Asia Pacific, and has designed, deployed and managed large-scale agricultural investment portfolios for a variety of institutional and private investors. Previous roles have included Managing Director of the Warrakirri Agricultural Trust and General Manager of Primag Australia Limited's Ag Fund. He is Chairman of the USQ National Centre for Engineering in Agriculture Research Group, and he holds a Master of Science from the University of London, as well as a Bachelor of Ag Economics from the University of Queensland. So to talk to us about the Blue Sky Waters case study, please welcome Michael Blakeney.
Thanks, Mick, and thanks for the opportunity. I'm going to take a little bit of a different tack today and probably talk a bit more about some of the opportunities agriculture's got without attracting new money. So I'm going to talk about water markets and how that can provide an opportunity to recycle capital into agriculture. A couple of disclosures first. Blue Sky does have a water fund, so we have a clear conflict and an agenda. Second disclosure, you can't help but bring up a number of horrible puns when you talk about water and investing. Capital flows, liquid markets, deep pools of capital. So I'm aware of them. I've tried my best to cut them down. If you get bored, it's the afternoon session, you can count them, and I'll do my best to keep them under 5. Firstly, so I'm going to talk about water entitlements, and I'm going to spend a bit of time just explaining what that means and what the market is, and how that market can provide capital flows back to existing agribusiness. So, as we've seen today, there's been a lot of talk about foreign direct investment, alternative sources of debt or equity, but I think what we're missing here, and there's a number of examples within the room here, is that we've got balance sheets that are heavy in capital assets, land and water. And we do this quite well in some other sectors, but water provides a really good opportunity, a compelling opportunity both for the investor and for those holding the asset to recycle capital back into, whether it's expansion, whether it's succession planning, any other number of activities, technological advances. I'll give you a couple of quick case studies and I'll sum up as well. So, investing in water markets. This goes back to some of the discussion we've had today. Larry Fink, BlackRock. And just to give you an update, that number is 3.5 trillion that BlackRock now controls, so greater than the GDP of Germany. Larry Fink, Mr. Fink as we'd like to call him, is saying go long agriculture and go to the beach. If only it was that simple. My experience has been is it's not that simple. I'd like to go to the beach like most other agriculturalists. That's probably where we spend most of our best days. But the issue is Mr. Fink's analysts seem to say we'll open that bottom drawer at least every 3 months, and in most cases every second week. So what I'm trying to highlight is, despite all those macro themes, which are all positive, it's real. We've got gentlemen like Larry Fink saying agriculture is a real opportunity. However, as with anything, the challenge is in the detail. Now, what we're seeing is, I suppose, and what we're hearing from investors when we talk to them about water is, these are the key things. We want exposure to global food security, and they understand that. So I'm not going to go into the graphs about where that demand's coming from. That point's well accepted. The challenge is, how do you invest in that to gain exposure? Do you pick one farm? Do you pick a cubby and hope it rains? Do you pick a portfolio and hope you've got the weighting right or the timing right? What we argue is, and again, you know, we've got a clear conflict, so be aware of that. We argue that water is the most efficient and effective way to get exposure to agriculture. And I'm not trying to tell you this to sell it to you, but I'm trying to highlight that water as an investment is attracting interest and therefore funds, and this will flow through to recycling of capital within agricultural businesses, which is a positive. Uncorrelated returns, we've talked about that. Again, we've got this climatic influence. It's not correlated to equity markets, and water's the same. Income in water, we derive an income from selling that allocation. So the bit you've got to get clear, which if you're not familiar with water takes a bit of time, is entitlement is the asset. That's the right to own some airspace in a dam. The allocation is the annual usage or the annual delivery of that water. So in funds like ours, and we're not alone, there are others in this sector who are doing this well as well, is we buy the entitlement and then we typically trade the allocation, or we lease out the allocation on an annual or 3-year or 5-year basis. So we derive real income on an annual basis, which investors seem to like. Plus, we've got the scarcity issue, so we're getting capital growth as well. And there's an argument that over time, when you've separated land from water, value's flowed out of the land into the water entitlements. And we've seen that in a number of basins. Liquidity, yep, we're in early. It's a deep market. It's a $1.7 billion per annum turnover a year in water entitlements. So that's reasonably significant. They're divisible and they're fungible. And what I mean by that is you can split them down to 1 megalitre, whereas, as you know, with farms, scale does drive some efficiency. It's not as easy to cut up a farm. Scarcity, again, same theory as land. There's a scarce value to it, so there's an inherent uplift in values over time. And the sustainability factor is people are getting comfortable with the approach the government's taking, not only from a market perspective, but from a sustainability perspective with water. So we've got scale, yet scarcity. Just to highlight, this Murray-Darling Basin here, that's where the bulk of the activity is. The dark blue is surface water, the light blue is your groundwater. So most of the activity's in this dark blue, and it's typically these eastern states that make up the southern Murray-Darling Basin. WA, probably not as developed over there at this point, likewise with the Northern Territory. 32,000 gigalitres, so it's a reasonably significant market. Values on that, and again these are general values, 25 billion. So again, highlighting this is a valid and significant market. And it flies under the radar a bit because people are always talking land. It's dominated by agricultural use. And despite suggestions of further infrastructure development, we think it's very unlikely that there'll be any new dams built in the near future. And I don't think that's stepping off the cliff at all, that's fairly clear. What we also like is flexibility. This is the southern Murray-Darling Basin, the interconnected basin. And for those of you that aren't familiar with this, the beauty of this basin is these rivers are all interconnected. So you can effectively have an entitlement here that may end up being used here or traded. What this does is, this provides opportunity, not just for people like ourselves who are involved in the financial aspects of it, but it provides opportunity for growers, for farmers. It provides arbitrage, which is always attractive to investors, and it provides innovation. But importantly, it allows water to flow to the highest and best use. And I'll give you an example. If the rice growers here or here aren't making any money, if they can't make their $90 a meg, it might go to cotton growers at Hay who make $300 a megalitre. If they're not making money and things are short, it'll go to the tree growers, the almond blokes that we heard about before, who are making extraordinary profits at the moment. So by investing in water, you're getting access across commodities and across regions. So this is a reasonably compelling argument, we think, to attract capital. And we're seeing that. We're seeing institutions, and I'm happy to report both domestic institutions as well as international, saying this is an opportunity. Liquidity, it's the first question they always ask. Oh, it's a small market. You know, if we deploy $100 million, we're going to move the needle on the market. Again, I hope I can highlight, this is water market turnover in that asset, in the entitlements. Now, you can say this is the value of those entitlements on an annual basis. Why the drop? Well, it rained there. So despite the scarcity argument, you're still going to be open to some fluctuations. There's no way you can get around that. And anyone in agriculture who's telling you can design something to get around the seasonal impact, perhaps haven't spent enough time in agriculture to realise that at some point it'll catch up. But my point here is it's recovered, or it's recovering, and the volumes traded are still significant. This is the allocation market. So 07, again, we had rain here in 09-10. You can see year on year, that's a fairly impressive curve. And in fact, when you do the numbers, it's a 25% year on year increase, despite the rain. As we're saying over here, you get some fairly significant fluctuations in price, but as an investment, that all evens out. It actually makes more money in drier years than it does in wet years, as you'd expect. So, hopefully, what I'm highlighting to you is that this is a reasonably scalable, reasonably deep, reasonably developed market. We've got scarcity, we've got sustainability, consistent government policy. That's the next point that's always raised by investors. Oh, what if the mandate changes? What if the legislation changes? But over time, the last 10 years at least, we've demonstrated consistent policy, and the water markets are central to that policy. Sorry, I've got the wrong one for you. Access to water is capped, secure title, so we've got case law and precedent that confirms that title. We've got transparency. There are water registers, there are water brokers. You can pretty quickly go on and see what water's trading on the internet anywhere across the Southern Murray-Darling Basin. And it's tradable. So not only does this work for the investor, but it also works for the grower, because they can match their production risk or their production outcome to their costs. So how does this provide capital to what we're talking about here today? The agriculture sector looking for capital. Well, as I was talking to someone earlier, what I'm going to show you is nothing new. This has been going on for quite a while. What is encouraging is there's momentum and there's increased interest from funds flowing into that water market, which means there's more opportunities for growers to look at recycling capital, readjusting their balance sheet. If you're an irrigator, and historically you would have had a significant portion of your capital tied up in water. So if we go back to the point where water was separated from land, it's taken a number of years for those values to balance out. What that meant is you may have this rather significant capital asset sitting on your balance sheet, which, as you know, reduces your return on capital. There are numerous examples where innovative growers have sold off a portion or part, or in some cases all of their water, which has in turn improved their return on capital because they've been able to access secure water at appropriate values to continue their production levels. It's not new, as I was saying. Dairy has quite valid and quite sustainable livestock leasing models, which are well used both in New Zealand and here in Australia. And land leasing's been common for a number of years in Australia, and indeed growing, driven by some of those international funds that we're seeing. The key point here is you don't have to own it to access it anymore. There's any number of products, innovative products, and as I said, we're not the only ones doing it. There are other groups who have got water funds, and there are other groups who have water-type products. There are leasebacks, there are hybrid-type ratchets where water pricing is determined on availability, or there's straight annual trading. What is exciting is water markets provide the opportunity and the capital. So what's in it for farmers? And in fact, what's in it for the sector? Because what we're talking about here today is how do we attract this capital? And I'm arguing, well, we're not really attracting it. What we're doing here is we're recycling capital. So it's a source of capital. You can progressively realise capital but remain in the irrigation game by selling down water entitlements. You don't have to sell them all, as I said. You might sell a proportion to fund debt reduction, technological advancement, increase your scale, any number of options. You can do a straight sale and lease back, so you're not even exposed to the annual water trading market. You can say, right, I'm going to lease back from you that water at X% based on its value over the next 3 years with an option for another 3. And again, this occurs now. It's not new. It's been going for a while. What is exciting is it's growing and it's releasing capital back into the sector. It's flexible. So in annual cropping, I understand perennials are a bit different and we can get to them later, but in annual cropping, there'll be situations where the returns you make don't justify holding onto that water. So a rice farmer, for example, if he can't make his $90 a meg, why do you bother? you're better off selling that to the cotton grower or to the almond grower and slowing your production or reducing your production. I think that's pretty clear. There's good risk management tools, and these are slowly developing, and they'll continue to develop over time. So they'll become more sophisticated. And as I said, the beauty of it is water moves to the highest economic use. We argue that it's a better investment than farmland for these reasons. They're divisible and they're liquid, and you can value them on a month-to-month basis. They're public and they're transparent, these markets. Valuations are simple. A megalitre of water in Murrumbidgee Zone X is the same as a megalitre of water in another Murrumbidgee Zone X. With the farms, they're always different. The volumes of trade, as we've showed you, they support access to allocation. Your use of it and where it flows will depend on the economics of production, and that'll move year on year. Importantly, it values water as an input. Whereas if you were trying to do it with farm, it's very difficult to cut out bits of your farm and still remain viable. I'm not saying you can't, but as a general rule, it becomes more challenging. Valuation, we've heard about that already. All farms are different. Talk to 3 different valuers, you'll get 3 different valuations. Sale and leaseback was brought up today, and yep, it's a valid option and a good option, but it's really limited to certain levels of the market. It's not that widespread, and you have to be an existing reasonable scale operator before you make leasing worthwhile. There's the emotional attachment. Despite all our arguments about this as a business, farming's different, unfortunately, and there's this, we live on our farms, so there's an emotional attachment to selling the land rather than the water. A couple of case studies, because Mick, I have been informed by Frank Delahunty that timing is critical at this point, given that the beer is on offer very soon. So Frank, I'm taking note of you. Annual crops. Cotton, both northern and southern valleys. This, as I said to you, this is quite common. We've got large corporate and family growers in the northern basin, where I'm familiar with, who over the last 5 to 10 years have sold assets and leased them back. Some of that's land assets, some of it's water. And their return on capital from the work I've done has improved significantly. Now, there's going to be a balance. I'm not suggesting growers go out and sell all their water or all their land. What I am suggesting is there are opportunities here to recycle, I suppose, latent capital on your balance sheet back into your business to either expand or do some of those other things. In southern valleys, we've got this added advantage of water trading, which makes it even easier. In the north, there's not a significant annual water trading market. Whereas in the south, you can pick any day the dollars per megalitre for temporary water and decide whether that suits your gross margin or your return profile and jump on it. Rice is another one. Rice growers have been doing it for years. Twynham, while they're not significant anymore, always had water trading opportunities with their rice farms in the Murrumbidgee. Permanent crops. Olives. It's public, so I'm happy to talk about it, but Boundary Bend, you've heard of. They did a sale and leaseback, which was quite well known last couple of years. Again, you may argue that you need water entitlements to secure your risk profile with perennial crops, but they're demonstrating you don't. Tree nuts, almonds, walnuts, pecan growers, all of them have expressed interest in looking at these opportunities. Vines, the wine sector is going through a tough time, and in many cases it's been the ability to sell their water assets, or a portion of their water assets, that's given the ability to keep going. So again, putting capital back into that sector. Dairy, we've talked about. There's both corporate and family farming dairies who have sold water assets, continued farming successfully, either freed up debt or it allowed them to get through that drought and kept going. As I said, they do it already with livestock, and 10 years ago you would have said you need to own your cows to milk them. Well, you don't. It's back to that theory of you don't have to own it to access it. I think what I'm trying to highlight is there's successful case studies across commodity groups and across regions. So this is real, it's happening and it's growing. And I hope you can see that by allowing this market to continue, you're attracting, one, capital in because they're interested in the water entitlement investment, but two, you're providing capital to the growing population to recycle into other opportunities. Some final points. There's still impediments. There's still challenges to attracting. This is what we hear, both domestically and internationally, when we talk to investors. Professionalism, and Dave brought up some of those issues today. We don't have a great reputation as an industry. We don't focus on the positive. Even this morning, the returns we brought up I wouldn't say attractive, but yet we leave out a lot that I suppose don't want to be highlighted or public, and they are pretty attractive. We seem to focus on the hard luck stories, and this is something we've got to, as an industry, have got to do better at. Perception and politics. That little episode there, the basin plan burning at Griffith, we face that on a regular basis. So I'm not sure how many years that was now, 5 years ago, but that little image and discussion pops up in every discussion we have with investors. Perception. Poor returns, we've talked about that. Track record, one of the issues we've got is you need a track record to attract investment flows. It's like any relationship, they want to see what you've done previously. You've got the responsibility of managing other people's money. You're not going to get it on a platter. You're going to have to work hard, and to do that, you're going to have to show a track record. Lack of a benchmark. This is one of my little hobby horses, again with Frank Delahunty, and again it's been brought up a couple of times here today. We have talked to every manager in Australia and said we need an independent index just to show what the sector's doing. And everyone says, great idea, but not me. I'll caveat that. Most of the people I look around the room who have got investments in this room have been very supportive and said, yes, we'll be involved. But the vast majority, 80%, have said, like the idea, just not sure I want to be in yet. Might show me up to be not as good as I think I am. So that's something we've got to, I suppose, grow up and mature and get beyond, because the Americans have it. The first thing they say in America is, where do you sit against the NCREF? And it sits as an asset class. They can say this is where ag sits against industrials, against residential, against commercial. So that's my little plug. We'll continue pushing that. Peer risk, it's another issue we face. No one wants to get in first. And you can understand that from an investment perspective. So the brave will reap the rewards. Valuations, again, we've talked a bit about that. There's been this disconnect between earnings and capital values. I think I don't want to highlight the negatives here, and I want to actually stress that we are getting better at a lot of this. So these issues that we as an industry are starting to overcome, which is really encouraging. Summing up, we do require a lot of capital, but I'd argue that not all of it has to be new capital. There's this opportunity to recycle capital, and that's an advantage, one, for new investors in the sector, and two, for those existing investors in the sector. We argue water entitlements offer this. You've got a developing and sophisticated market, you've got a number of people entering the market, and as I said, we've got a fund up and running. I know others in the room have got funds up and going. It's starting to gain momentum, which is fantastic. It's established, liquidity's improving, innovation's starting to flow through the sector, and a track record's emerging. So, in my final comment, again, I think it's important we don't always look for new capital. There's opportunities to use capital we currently have in different ways, and water markets is just one example of how we can do that. Thanks, Mick.